point here is to reduce the cost of doing business. So how would that work? If we look here at historic price levels in the United States, you get a very interesting picture of the purchasing power of the dollar over time. So if you go back to when our country was initially founded and fast forward all the way through the early 70s, you can see that the purchasing power of the dollar was pretty stable. There's virtually, negligible inflation, except at times of war. For example, the War of 1812, the Civil War, the First World War. These were all periods where there was inflation, and these also coincide with periods during which the federal government went off the gold standard, went off a commodity standard, and issued fiat currency. For example, during the Civil War, you had Lincoln's greenbacks, which were purely fiat, and were issued to be able to fund the war. So you have this just real-life example of the stability over time, gold and silver coin used as money, and how when gold and silver are being circulated as money, it has a very stabilizing effect on their purchasing power over time. By contrast, when it's used as commodity solely and goes in and out of favor as a preferred investment, you can see more significant swings in valuations, and we see that to a certain degree today, especially with the consolidation that occurred last year. After 12 years of increase in gold and silver, we saw a drop from the prior high, and a lot of this is because gold and silver is being viewed as a commodity, and also the strengthening dollar because of confidence in the system. But if you look at this chart, you can see the direction that the purchasing power of the dollar is going. And there's really nothing to stop that. The policies that put us on kind of that skyrocketing direction, really those have not changed, and they've just been reaffirmed very recently. And so I think that we can see that will increase. Another little thought experiment that you might do with this is just think in your minds of the old silver dime. I know when I was a kid, I could go down to the 5 and dime store, not the dollar store, the 5 and dime store, and I could buy all kinds of goodies with my 10-cent allowance. You could buy a loaf of bread for a dime. Today, you can buy a slice of bread for a dime, but with a silver dime, you could still buy that same loaf of bread. Well, hopefully not the same loaf of bread, but a similar loaf of bread, because the purchasing power of precious metal coin historically is maintained over time, not only throughout U.S. history, but if you go back and look even in ancient times, the Roman center, if you buy a suit of clothes, including a toga, a sash, tunic, some patent leather sandals, for about an ounce of gold, and a U.S. senator today could buy a suit for the same, along with all the accessories. So I think that that's fairly well established. Also, economic historian Brian Dimitrovic of the Sam Houston University has undertaken a very careful review of U.S. monetary and economic history. Commenting on the gold standard, he said, the achievement of simultaneous price stability and economic growth was so outsized that we hardly recognize this kind of heady economic performance as even possible today. Yet this is the real economic record of the gold standard. He pointed out that, again, price stability, so essentially zero inflation, decade after decade after decade, with record-breaking growth in the gross domestic product. In fact, Dr. Dimitrovic has calculated that if the U.S. government had continued on the same growth pattern throughout its history that it did during the period that it was on the gold standard, today we would have a gross domestic product of $28 trillion instead of 14. We'd have average take-home pays of $75,000 instead of 40. So there's a real economic cost that that Americans have paid and the citizens of any country that has this kind of a fiat currency system, which is virtually every country in the world today. There is a very significant price that's paid by the economy as a whole and by citizens individually for supporting that kind of a monetary system that sucks production capacity and capital out of the private sector and into government coffers where it is very inefficiently used and spent. It's also very telling. Researcher, is a research fellow at the University of California at Berkeley, Bernard Lietaer, has identified using World Bank statistics only 48 major banking or monetary crises in the nearly 3 centuries between Holland's tulip mania crash of 1637 and the 1929 Wall Street implosion. Only 48. By contrast, the World Bank has cataloged more than 270 similar financial crises just between 1971, when the U.S. went off the gold standard entirely, and 2011, a 40-year period marked by central bank control of worldwide fiat monetary systems. I think that's a very telling statistic in terms of the fragility and susceptibility to shocks and crises that our current system has, and how much more stable a commodity-based system is.